Hey guys, welcome back to Trade with Jen. Now, now I know I drop weekly videos, but this week you guys gonna get a bonus one. Now, why? Somebody that was close to me had watched my last video that I just dropped, and they gave me some feedback. The feedback was that I spoke in it like I was speaking to somebody that was like well seasoned in trading, and I had to rewatch it, and I did catch myself just kind of just speaking, just going with the flow. Mind you, I've been doing this for years, so sometimes, you know what, I'm glad that you guys are able to catch this and see this because I do have to consider the fact that a lot of you guys are beginners. So I did wanted to correct myself, come back on here and actually drop market structure part two, where I do elaborate a little bit more visual with demonstrations. So that way you guys can have a better understanding of what I was speaking on. Um, with that being said, guys, all my videos are definitely only for educational purposes. So let's go ahead and dive into it. All right, guys. So I promised you guys a better breakdown of what market structure is. Now, market structure is actually really simple. Like I said on my last video, market structure is definitely exactly what it sounds like. It is the structure of the market. Now, there's mainly three different things that we all should be paying attention to, especially as a beginner. We should be able to identify when the market's going up, when the market's coming down, right? In terms of trends. Now, we should also be able to identify when the market is really not doing anything. And in this case scenario, that is what we call a consolidated area. Now, let me go ahead and pinpoint. Those three main things that I just spoke about is, well, let's look for consolidation to begin with. Consolidation is literally anything that goes sideways, right? In other words, it's also considered to be ranging at this moment, right? Consolidated, ranging, just different terms. More so, they pretty much mean the same thing. Okay, so this right here is definitely considered to be a ranging market. Ranging slash consolidated. Now, let's go ahead and identify what a bullish market is and what a bearish market is. Again, we're only going to pinpoint the main essential things of what market structure is really about. Now, when we're looking for a downtrend, also known as a bearish trend or a downward channel, it's literally, there's so many names to it. We want to be able to pay attention to things that look like this. Okay, so a downtrend is typically something that looks like this. Okay, this right here is considered to be a downtrend, aka a bearish trend. Now let's look at what an uptrend will look like. An uptrend obviously is going to be going up. So this right here is considered to be a bullish trend, upward channel, whatever it is that you call it. Right? So, granted, all of these trends are never going to look as perfect as I drew them, right? You're going to see similarities. Apparently, you can see a similarity when, the market's going down. You can clearly see when it's going down. You can clearly see when the market's going up. Again, when the market's coming down, okay? So that right there is market structure. Now, let's go ahead and see what this essentially looks like. Let's look at a downtrend. So typically, yes, this is a downtrend, guys. This right here is a bearish trend. Like I said, guys, it's never going to look as perfect as this is. Or we're never going to see a bullish trend, right? As perfect as what this is right over here. It's always going to look really ugly. Okay, but you guys definitely can get the point of when the market's coming down or when the market's going up. You obviously see it coming down, and vice versa. You obviously it going up. A ranging market is anything that does equal highs and of course equal lows. Okay, equal highs and equal lows are typically just these. I touch right here, I touch right here, again, it touched right over here. On the bottom ends, you can see that it's touching the same price point multiple times, guys. These are considered equal lows, and these are considered to be equal highs. Now, when the market is trending down, you got to remember, when the market's trending down, you guys are going to often hear the term lower lows and lower highs. When the market is trending up, you guys are going to hear the term higher highs and higher lows. Okay? Now, the easiest way to learn how this actually is going to mold into your head is, I know lower lows, lower highs, and higher lows tend to get confusing for a lot of beginners. Think of it like this. Whenever the market is trending up and it's going into this bullish form, it's just going higher, right? The most common thing is, yes, we know that it's going to go higher because it's going up. Now, whenever the market is bearish, or in other words, on a downtrend, it's definitely going lower, guys. It's making lower low, lower highs, lower low, lower highs. Okay, so this is how you guys are going to see it. Lower lows. The lowest point will always be on the bottom side, guys. Okay, and then the lower highs are going to be what we call pullbacks. Okay, just like this. Same thing right here. So whenever it goes high into a bullish form, we have the higher highs on the top side, always on the top side, guys. You will never see a higher high on the bottom part. And then we have higher lows, or high lows, if you will. Okay, high lows right over here. So you can't have a higher high without a higher low. And you can't have a lower low without a lower high. And obviously right up here is going to be our lower high. These right here, equal highs and equal lows, it's just something that if it's just ranging sideways, you want to be able to kind of spot on whenever it's breaking out the trend. Right here, we seen a little fake out, more so it came back down, touched an equal low before it actually shot up. Okay, right over here, it was definitely downtrending, but the moment it created a new higher high, basically going higher than the last lower high. Now, I don't want to confuse you guys because this does tend to get a little bit confusing. But for the most part, I want you to just understand that, hey, whenever the market is actually bearish, we only use these terms, lower lows and lower highs. Let me just go ahead and place it right up here for everybody's reference. Bearish, okay, so this is a bearish market. Or let me just say bearish trend. So this right here is considered to be the bearish trend, and this right here is considered to be the bullish trend. You guys can pause the video, take a screenshot, whatever it is, okay? But this is plainly what market structure is whenever we identify uptrends, downtrends, and of course, ranging areas that are just equally having highs and equally having the same lows. Okay, well, that was it. I hope this was a lot more better from the last video. This is definitely a lot more beginner friendly, so you guys can definitely study this. Don't forget, pause it, take a picture, however, so that way you guys do not get lower lows, lower highs, and higher lows mixed with any trends. Okay, well, thank you guys. If you guys found this video really helpful, please do not forget to like and subscribe, guys. I'll be dropping more videos throughout the week. And yeah,